Welcome back to the Deal Vault podcast. If you're a real estate investor looking to scale, secure funding, and learn from real deals, you're in the right place. I'm Greg, and together with Nate and Sarah, we'll sit down each week and break down market trends, funding strategies, real deal stories from our investors. Now, if you're ready to unlock knowledge, relationships, and capital you need, let's open the vault. Well, welcome back to the Deal Vault podcast. We've got super special guest with us here today, Brian. Thanks for being in, man. Appreciate you coming in a little bit early today to talk real estate, talk shop, and see if we can get anything intelligent out of this conversation. So
That's hard. Yeah.
it's quite difficult sometimes, but I have confidence that we can do it today. So yeah.
We like to have a lot of fun. So I guess, Brian, if you want to just tell us a little bit about how long you've been with LoanBidz, just kind of your origin story with coming here, that would be awesome.
Yeah. Been here for about 4.5 years and been loving it. There's a lot of challenges in the market since I started. I started right when rates were going up. So I think the first deal I ever started here, I quoted them at 4% and it ended up closing at 5.5%.
Okay.
Just because that's
Yeah.
the market we were in. So,
Okay.
it's been different these last couple of years where rates are kind of coming down finally, which is different. So it's fun to kind of navigate that instead of always having the conversation with the borrower of, oh, your rate's going up.
Yes.
So sometimes it's a different environment now. How I found here was just luck, to be honest. Looking on LinkedIn and found the job posting. I was doing sales before, saw the post like you can make 60 to 80,000 your first year. I don't remember what the post said, but I was like,
Probably a bazillion.
yeah. I was like, I don't
We're coming off a low rate environment, and
coming from other sales places are like, no, I don't believe it. But I wasn't making any money at the time. So I was like, why not just give it a try? So I was like, shit, it's been great. It's been good.
awesome.
So, but I was just doing ticket sales in Branson, Missouri. So if you've ever been to Branson, Missouri, that's what I was doing, selling show tickets essentially to go see
Yeah.
these
Go see Dolly
great.
Parton.
Dolly Parton was a big one, and
Yeah.
just all the random shit
Yeah.
that we had in Branson. So
That's awesome. We kind of make jokes. It's funny, our team kind of feels like a bunch of misfits that ended up in the mortgage world. Even just personal experience, what was your exposure to mortgage or investors and those conversations before coming here?
yeah, honestly, not a lot. I didn't have any real exposure to it. My parents are thankfully very helpful in my life, but they bought a house with me
Mm. Yeah.
out, and they did all the stuff to
All the
do
big,
it. You know what I mean? To actually
totally.
get it. So I didn't really have any actual experience in
Yeah,
how mortgages even really work.
for sure.
I started here pretty young. 26, I believe, is
Yeah.
what Alda was when I started. So,
Mhm.
didn't have a lot of real life experience. I mean, I'm 26 is you can definitely have that experience depending on your upbringing. But for
sure.
me, that wasn't my life at that point. So
Sure.
it was a big learning curve of just mortgages in general.
Yeah. What's been the most enjoyable part of, since that was kind of a new world for you, learning about that or the relationship?
Sure. For me, I'm numbers, they just come to me very easily. So that's fun looking at deals and just kind of seeing what kind of works and just, because a lot of it with any real estate deal is just numbers.
Yeah.
And that's where there's a lot of analytically driven borrowers who are, can dice a deal every way to Sunday. But there's usually only one real thing that really makes sense
Yeah,
is profit at the end of the day. That's why
for
you
sure.
get into real estate. So,
For sure.
trying to bring borrowers back to that and just
Yeah,
have that good mindset to
definitely.
break those things down. But 75% of X,
Hmm.
very good at just getting
Hmm.
very close to us.
Yeah.
I'm just I think I know what this number is. So,
No,
um, yeah, so
that's
just doing that.
well, and you're really great at connecting with people too. So hopefully just that confidence of the unknown in the mortgage world and the real estate world has helped, I think you grow those relationships off the bat. But I know when you said when you started you were 26, but there's been jokes around the office because you may have just unlocked a new mode, dad mode,
Ryan.
dad Brian. So tell us about that a little bit.
Yeah. It's great. Love it. She will be 4 months and tomorrow. Tomorrow's the 23rd.
Yeah.
Yeah, she'll be 4 months tomorrow.
Mhm.
So it's really great. I mean, there's always challenges and struggles with babies, and we definitely ran into those. She's actually really, really good so far. I know there's the 4-month sleep regression. Me and
Mhm.
my wife joke that like every week there's a sleep regression.
Yeah.
So like
Yeah.
there's always some reason why the baby's not sleeping throughout
Yeah.
longer periods of the night.
Yes.
So that's kind of our joke. It's just like,
Yeah.
oh, sleep regression, of
Yes.
course.
You're
I'm sure she read that in a book and said, "This week, my job is to have this."
Yeah, exactly. Oh, this week she's growing a lot. This
Yeah.
it's she learned something new,
For
and
sure.
whatever it is.
Yeah.
This is why she's not sleeping well. She's
Yeah.
not sleeping well because she's a baby.
Yeah,
But that's
that's
perfectly fine.
it is a wild world, and you think you've got it figured out, and then something changes. It's good though. But real estate and managing mortgages definitely prepared your stress tolerance, and I'm sure in some ways for being able to conquer a new change like that. So
Sure.
that's awesome.
It's been great. Been great.
Yeah, well, I think we would love to just get to know you a little bit better when it comes to actually interacting with your investors.
Sure.
And so I think it would be awesome for you to just share a little bit of insight for the investors in the room, again, that may not work, in this space much, right? They may not use private lending, or maybe they do, but they feel like they kind of fumble around on their own some. So why don't you share a little bit about a borrower of yours, maybe their projects, kind of how you help support them with their deals and built that relationship?
Of course. So I think when you're especially looking at private lending, um, I think a lot of people's first kind of intuition or thing about it is going to be rehab loans or something like that. Like they're
Yeah.
thinking of more of the hard money,
Yeah,
but
for sure.
being in the industry for so long, like hard money, you have to really break down like what does that mean?
What do you even mean
Yeah.
by that? Then I'm teaching a class of new account executives this week, and we talked about that. Hard money is not a word that gets used nearly as much as certainly when you started and when I started, and that's a good thing because hard money at minimum has negative connotation, and certainly has various meanings to where depends who you're talking to.
Or just shady business practices at times as well.
Absolutely, like, there's the baggage that comes with that, and, yeah, I'm guessing a lot of people came in, to knowing you certainly in 2022 when you started.
Yep.
Hard money, "I gotta give you this hard money."
Yeah, and again, DSCR and all of it's very new to the space. I mean, I know it's, been somewhat prevalent since about 2016, but like
Yeah.
in the lending industry, that's
Mhm.
nothing. I mean, that's,
No, it's
we're
we're in our adolescent years.
so
That's right.
you see a lot of lenders in this space that they're like becoming more institutionalized for sure. There's, things that they're finding in the industry that are causing more foreclosures or
Yeah.
whatever of like, hey, we need to adjust this so,
Mhm.
we can sell these notes or whatever it may
Mhm.
be that, I think at times can be a struggle in this market. Like, I think a lot of people who are like, I've done 15 loans with this lender,
Yeah.
they can't give me an exception for X, Y, or Z. And it's like, I mean, these
Yeah.
CR loans are very, to the numbers,
Yeah.
cross your T's, dot your I's,
Mhm.
and because they have to sell the notes. If they can't sell the note, then
Yeah.
they can't do more
can't have
loans.
Yeah.
Correct. So,
Which that is a good point. I mean, when it started, it was a little bit more mom and pop, and you can make exceptions, and it was more focused kind of in the fix and flip, right? Where it was lenders were keeping those loans on their books. They weren't selling them to capital markets, and so they could kind of go a little rogue. And in those, I mean, the hard money lenders are still, I would say, the more flexible in some ways. In others, their credit box, maybe geographically tighter or
mhm.
have other kind of comfort levels that feels more mom and pop,
Sure.
but they do have more flexibility. But kind of what you said is like the world is growing out of private or of hard money into private lending. And even in the industry, they're kind of like, I don't know. I think it's risky when you throw any really descriptive words like hard or easy or fast, in your name. Because again, it's not as hard as it used to be. And there are still those mom and pop options, but even they have gotten more institutionalized
Oh, for
as
sure.
well.
I think just like looking at it of like setting that expectation with whoever the real estate investor is of like if you're going to get into these loans, you really need to know what you're doing. Um, for example, had a long-term DSCR loan had a closing date that was 20 days away, and a long-term refinance, it's hard.
Yeah.
And I actually just talked to him about a week ago to kind of like, hey, let's do some other things. And, his biggest gripe was like, the process took too long. We ended up closing that DSCR loan in like 24 days,
Yeah.
which is, in this industry, not the easiest thing to do because,
Yeah.
again, they're crossing the T's,
Yeah.
in the I's. So it's
Yeah.
like,
Wait for an appraisal.
yes,
Wait for title work. Wait for insurance.
exactly. But he's
Yeah.
he's in the mindset again of like, this is hard money. Like, this should be
Mhm.
just easy. You guys should just
Right.
do it to do it.
Just
Like,
don't ask for any paperwork.
correct.
Look at the bare minimum and then just go.
Yeah. And that's
Mhm.
that again, DSCR specifically has gone a lot away from that.
Mm.
Just because again, we talked about selling notes is how they keep the business
Yeah.
afloat. And if they can't sell it, they can't do more loans. So like
Right.
setting that expectation on the DSCR side is super important. Of like, hey, you're gonna send this document.
Mhm.
They may need a correction. They may need a revision
Yeah.
here or there.
Mhm.
But you can still find that in fix and flip. Like
Yeah.
there's a lot of small shops that we're kind of talking about where they're trying to build a relationship and their biggest goal is,
Yeah.
can you execute on this loan and get out of it?
Right.
And we'll start doing better loans or we'll give you more leverage or whatever
Right.
it is. And so finding that lender, if that is your true goal, hey, I want a lender that can close a week, 2 weeks,
Yeah.
but I can actually build a relationship. That's probably the space that you're looking for.
For sure.
Is that like, hey, let's find a rehab lender who can do X, Y, and Z.
Yeah.
I like the process first, maybe not the terms and the leverage first, but like that can grow with some of those guys of like, hey,
Yeah.
do some loans with them. They'll start to make exceptions here,
Mm.
potentially give leverage here, whatever it may be. So
Yeah.
that's where you can find it. Speaking of that, like even the bigger rehab lenders, they try to have that old school
Yeah.
quick feel. A recent deal that I had with a lender, they have a couple different options for appraisals, which
Yeah.
is like BPO. You can do a BPO, broker's price opinion.
Yeah. Yeah.
That is, or a full appraisal. Typically a BPO is going to be a little bit faster, a little bit cheaper. Every borrower
What's
always wants to go faster, cheaper, but like
Those
those
are conservative value.
correct.
Yeah.
And that's actually what we ended up running into is
Yeah.
conservative value. We also ran into an issue where their zip code, for whatever reason with this lender, they don't like, whether that
Yeah.
be the values kind of staling
Declining
or
market.
declining or
Mhm.
whatever it may be. And so they are getting even more conservative, cutting
Yeah.
coverage basically on the after repair value.
Mm.
So to say that of like, these guys are trying to be like faster, give you the
Mhm.
cool options and things like that,
Mhm.
but like they still are going to have some limitations in
Yeah.
certain places. And again, going with the BPO, we did get a conservative value.
Yeah.
And so that's where it's like,
If you
oh,
would have gone a little bit slower and maybe did the more conventional, like full appraisal or a more detailed valuation where there was a real inspection, and just more involvement, then you might have gotten a more true to what they thought value.
sure.
So yeah, that's interesting. Just the valuation and the speed. But I think like what you said is even the hard money lenders have evolved. So for the investors that are here that have been in the space for a long time, they may be feeling those pain points. And the same lenders that they've even worked with are starting to tighten up their credit box
Sure.
because even those lenders have more accountability. They have more people on their team that are looking at the loan performance. They may be even borrowing money where they have to be accountable if it is in their account, and it is on their balance sheet to the performance of the loan. So there is a lot more expectations. I think we've seen some lenders that have come in the gate in the fix and flip space with a box wide open. And it's like, wow, that's really, are you sure? Our team's kind of like,
Yeah.
okay, we'll give it to you.
Predictable.
But then it's hard because we start sending business there and then they slowly start tightening their credit box. So we've seen, I think you and I were talking about this the other day. We were talking about a few of our lending partners is like, it feels like, some of them are opening up because they started mom and pop and they're starting to spread more geographically. Or maybe they weren't looking at credit. Now they are looking at credit, but they're still expanding while others came in gates wide open and they're like, oh, wait, hold on just a minute. And they're going the opposite direction. So you kind of get both with the fix and flip space with the partners that we have. But again, that's where if you're an investor that's been in the industry, like maybe your same partner isn't the best anymore. Maybe there's newer options that are better for you. And so that's where we can add value, even with the short-term fix and flip deals that have been more of the true hard money deals. Like even those lenders have evolved a lot.
Yep.
And grown.
I
So
think you have to know what you're doing as well. And then when I say know what you're doing, I don't necessarily mean real estate. There's people that I work with all the time that,
yeah,
they just are more risk adverse. And they're like, well, I'm just going to do it to do it. But like,
yeah,
you got to know the deal. And I think that's where like becomes super important, knowing your market, knowing the deal. Because some of those conservative values that we're talking about, like if you do the PPO or if you do the companies that don't even do an appraisal, like
mhm,
they're going to be conservative on value because that's just they have to because
yeah,
they're
Yeah,
keeping the
book
note.
data they have to cover down.
Correct.
Yeah.
So the biggest thing is like knowing is like, is my project that I'm doing in the middle of the market?
mm,
Like if you're doing just your normal, 3-bed, 2-bath, single family home that
yeah,
you're not putting all the bells and whistles on, just gonna be a nice renovation.
right,
Maybe you have better luck doing the BPO or the no appraisal options that move
A
quick.
lot of data out there that
mhm,
supports your normal house.
Correct, correct. And that's where I see a lot of people have struggled and we've stopped, our company has stopped, because of us, the salespeople and the company of like not wanting to use certain appraisal
yeah,
companies because they're like, these values just don't come in where the borrowers expect them to.
yeah,
Well, they're trying to get a $600,000 value and the median in
right,
this market's 300,000.
right,
So like
right,
there's just not as many sales to dictate
It
that.
could exist,
Correct.
but at that point, you're asking the appraiser to stretch to the absolute maximum that a market could maybe support. That's just not a reasonable expectation.
Oh, for sure. And especially with the lenders again that we're talking about, because that's where a lot of fix and flip lenders are going is they want to not do a full appraisal
yeah,
because that gets
Go fast.
they want to go fast. That's what everyone's kind of biggest harp is. Can we move fast? Can we get this thing closed? Can I not pay as much money to get the loan to the closing table? Like
yeah,
that's what people are looking for, but that comes with its own risks and barriers. It comes with, hey, you've got to make sure that you have some wiggle room on your
yeah,
ARV, or you have some wiggle room on how much can I bring to close on this
right,
specific deal.
right,
Because any loan that you're looking at, especially in rehab space, it's always the caps of how much can I give you up front, and then how much are we going to cap it from the after repair value standpoint.
mhm,
So if your after
mhm,
repair value comes in at 100,000, just to make an easy number. A lot of these lenders are, again, conservative. They're not going to go to your usual typical max in this space of 75% of the
right,
ARV. They're just going
right,
to go to 70
yeah,
because again, they're
then you
they're
can
look,
have
they're looking out for themselves.
yeah,
Between the purchase money
yeah,
and the rehab money in
Yeah,
combination would not exceed that 70, maybe
correct.
mhm,
75,000
mhm.
on that. That's
S-
that.
So let's talk a borrower
Sure.
who maybe there's kind of two scenarios. A borrower that really, really knows the deal well and they're confident in the deal. And when it hits underwriting, they have confidence because they're like, no, I just did the deal next door.
Yep.
I think you have those borrowers, but also what about the ones that get angry at underwriting? And here's what I want to just call attention to is like yes, lenders are protecting themselves, but they're going to catch things about the deal that don't math out.
Yep.
And I think a lot of borrowers end up getting mad and make the underwriter the bad guy
Sure.
instead of which again, if they're the
Or
person that knows the deal and they're like, "No, this value, I have a property," like that's easy to dispute because they know their deal, they know the market.
Mhm.
We can just send that info over. But for the ones that don't and they've overvalued overshot the return on investment or the DSCR is off, like that's actually a huge advantage.
Sure.
You don't actually want a quick underwrite because then what's going to happen is like you're saying, "Oh, they're saying yes," but they're not protecting you either
Correct.
because if they're not getting paid back, guess who actually is getting hurt the most?
Sure.
The investor.
100%.
Because these lenders have money. They'll get over it. But an investor like that could be catastrophic. And I think so often we are having our investors like walking with them through that moment of like, oh my gosh, this deal doesn't math out. And I'm mad and I'm going to be mad at the underwriter or mad at you, Brian,
Sure.
because you didn't. It's like, well, when all of the paper and all of the figures were actually put out there, like this may be a deal you should walk away from.
Yeah, For
Yeah.
instance, like if you're going to flip that property for sale,
Mhm.
the next person, the family that's going to go buy that, they've got to go get an appraisal as well.
Yep.
And all that same stuff that Mr. Underwriter is finding. Well, guess what's also going to be found when you go to sell this in a few months?
Mhm.
All of those same things. Like, it's not that they made it up out of thin air. Like, that's the information that's available that the other person at the end of the day that's going to buy that, or you got to go get another appraisal if you want to refinance it. You're subject to that third party information. You may not love it, but like it is how it works.
Yeah.
And it's, man, really nice to know on the front end that, oh man, I got to reckon with this. Do I have a solution for that or not? I mean,
Yeah.
sometimes there is a solution for, oh, well, then we'll pivot and do
Sure.
this. So,
And that's how I kind of pitch it with my borrowers a lot of the times is, the space is still DSCR. Like even on the fix and flip side, it's DSCR.
Mhm.
I know DSCR is you're doing your rent over your expenses,
Mhm.
things like that. But like
Yeah.
they're still looking at DSCR, how I break it down to my clients. Are you making money monthly on the rent? That's it.
Yeah.
Same thing on the fix and flip side. Are you making money if you were to sell the property? That's what they're kind of looking at. And it's a great point of like, these lenders are putting these rules in place to protect themselves, but you're 100% right. To protect the borrower at the end of the day. Like you don't want to give the borrower the moon and then, they can't repay the loan or whatever it may be,
Yeah.
to get into like a specific deal is, I kind of mentioned it earlier, the borrower who did the BPO, and they know the market. This would be their fourth flip in this area.
Yeah.
They know the market. I think that they had to struggle with one, the BPO came in a little conservative on the value,
Mhm.
but also like again, it goes down to knowing that deal and taking some time of
Mhm.
like the property was listed for sale 1,400 square feet.
Okay.
We get the appraisal back. It's 1,000 square feet.
Mm.
Oh, where's the 400 square feet? Oh, it's this basement that's not finished.
Yeah.
Oh, you didn't detail on the scope of
Right.
work that you're finishing the basement.
Yeah.
So the appraiser's looking at this like, okay, this is only
Oh,
1,000. It's only 1,000 square feet.
Yeah.
There's nothing telling me that this basement's being
Mhm.
finished. And for me, it's like, I'm again, like you said, I'm the bad guy because I'm bringing the news to them. But again, I was like, that's more of the seller. Like,
Well,
the seller shouldn't be listing it at
yeah.
1,400 square feet when it's not. Like,
There's some clear gaps there.
oh, correct.
Which again, it's like I can't read your minds, like we can't just assume things, and if it says 1,400 on the listing and then there's no note on the scope of work, what are we supposed to do with
Yeah,
that? So
yeah.
so tell us like what are you telling that borrower to do? How are we working to fix that or
We
maybe
closed that
move
deal.
forward?
We did close the deal.
Okay.
The biggest thing that we did for that is we ended up having them redo their scope of work
Yep.
because they already had in the scope of work of finishing the basement. But that's again, it comes down to the details. It
Yes.
comes down to this person coming in and appraising the property. Do they
Mhm.
know what you're doing?
They don't.
And that's the biggest thing too of like, I get it. It's hard with like the scope of work. It's been one of our biggest struggles as
Yeah.
a company of getting
Mhm.
people to do it and do it well.
Right.
It's going to return you the time and effort that you spend
Yeah.
doing it
Yeah.
just to do it well the first time. Because what ended up happening is, we had to push the closing date back. The
Mm.
seller took their earnest money. Not a lot, $500, but like,
That's not-
they lost $500
Yeah.
that they just had to throw into the deal to keep the
Mhm.
deal alive.
but on their first trial on that scope of work, they probably saved 10 minutes, I bet.
At least 10 minutes.
But-
Probably not a good
Yeah.
trade-off.
So no, agreed. And that's the thing is just like, but again, it's hard because, and how they market the property is important too. That's where that's what I was trying to tell the borrowers. Like, hey, I mean,
That's why I
don't
think
love that. That
borrowers could
all the time.
Yeah, like-
But
do
not
better.
on agents like 1,400 square feet. That's not true.
correct.
It is untrue.
Yeah.
There's another word for that.
Mhm.
Like you can't do that. We see it regularly. At the end of the day, if you're the person borrowing it, like you got to do your due diligence.
For
And
sure.
part of that is partnering with the lender. You get an appraisal, like you get title work, you get all this stuff, and that is part of the due diligence. Isn't it nice that we caught that? Because if they had not, and let's say that scope of work didn't properly have it in there, they didn't get the permits to get those extra 400 square feet. Guess what? When they go to sell that or refinance it, new appraisal comes out, you're running into that same problem
Yeah.
again, but now it's like the exit. Now I can't get out of this thing. We got a real problem.
Even faster though than that is like, you have this money allocated to finish the basement. it's not allocated in your scope of work.
Mhm.
When you go to take that draw, hey, I just spent $10,000
Right.
finishing the basement.
Yeah.
Wait, on what?
You go, wait,
Yeah,
yeah,
there's
you're
that.
not gonna be able to draw that
Yeah.
money to get that back to
Yeah.
the next thing either.
Yeah.
So it's like
Yeah.
having that super important. But what we ended up doing is just redoing the scope of work,
Yeah.
keeping the same budget and detailing, hey, we are finishing.
For
and
sure.
Got that over to the appraiser.
For sure.
They ended up adjusting, basements again. They're not gonna have as much value
Yeah.
as above ground living area,
Mhm.
but still
It's still value.
it's pushed it up enough to where the
Good.
deal almost kind of hit exactly what I quoted.
Yeah.
It was a couple thousand, still a little bit
Mhm.
less because again, we hit one of the declining markets and there's
Yeah.
being more conservative
Yes.
and
Yeah.
it happens. And I think that's a big thing of like fix and flip space is being flexible. Like you have to have some flexibility into it because there's more than one thing that they're looking at.
Yeah.
That's where like DSCR can be a little bit more cut and dry.
Like you got to keep all of the things in sync. And I would say, going back from what I heard you say, there were a few kind of key things that just going forward as an investor you could take, right? Do some due diligence on the property on your own. Don't just trust the listing, whether that's going to a realtor or even coming to us with a property. We have property data stuff that we pull after an application, but we can help support and just clarifying the truth about the property a little bit more before scope of work is done. The next thing you said is spend time and effort on your scope of work. Add the details because that's in your brain. And if you don't put it out there, we're not going to know to ask and the appraiser's not going to see the value. And so take the time to do that. And I think the third thing is just trust us as your teammates, right?
Yes.
To be there to support you, whether it's walking through a challenging value or underwriting. Like we can help problem solve with you. But also just thinking through the deal ahead of time will make our partnership more successful.
I think there's a fourth thing too when you look at it.
Yeah.
It's like instead of chasing the terms, chase the process. Like, especially in fix and flip.
Yeah.
Like that's
That's
where
Brian.
that
That's dad.
That's a dad mode. Dad mode. He's like in a whole nother.
it's not anything like that. It's just that like I think that's where again, if you talk about relationship building, I want to build a relationship with the lender.
Yeah.
Like, we did this loan with a very big lender. They don't care.
Yeah.
They really don't. Like
Mm.
for any specific deal, like they have their process. It's hard to push timelines. Like if you're looking for a lender, especially fix and flip space, that can execute quickly. And
Yeah.
that's again, I think that's where we need to look at first is like that's what you have to figure out first. Is
Yeah.
what do you want in your loan? Can you find properties that are great? And you can find good sellers who will give you 30 days, maybe even be a little lenient,
Yeah.
run into problems of 45 days.
Right.
Sure, maybe, but you need to find someone
Yeah.
who can, especially on the fix and flip side, because that's where a lot of people are going to have the struggles of like, I think in the, long-term space, everyone's like, oh yeah, this is going to take 30 days to close, or at
Mhm.
least something like that. But
Mhm.
like fix and flip, you're getting purchase
It
contracts.
was 3 days.
2-week close, 1-week close that like not every lender in the industry can
Yeah.
close.
Some can, some can't.
Yeah.
Sure. Yeah, and I think what you said is very important. Is like if you have that as a factor that needs to be met, then maybe process goes up in triage above what's my rate?
Yep.
Or whatever it is. Everybody's pretty competitive, like for the most part, but it's those process things that can be and make all the difference in the world. And if you don't know that, right? Like I haven't worked with this lender. That's where like we can bring the experience to the table of like, here's what I have done 30 times already this year with this loan program. Even if you haven't experienced that, because this is your second or third deal this year, we're bringing that experience to the table to show you here's what it's like, and here's how this can meet you where you're at on your deal.
And we bring the importance. Like again, we were talking about this big lender not caring about your one loan. Well, we have 50 with them.
Yeah.
Care about our
They care about-
They care more about our loans,
For sure.
which is nice, because we
Use
can
our relationship.
We can use our relationship
sure.
on certain things.
Yeah.
Of course, there's things that we
Yeah.
can't, but like that's where it comes down to.
Sure.
Like building the relationship. I think you can build it, especially in fix and flip space. Figure
Mhm.
out what you want.
So
It helps to be cool, man. Like realistically, like it's real estate. There might be something that changes a little bit. Staying solution focused can be really important versus losing your mind when this actual thing comes up that's for real. 400 square feet basement. Like we got to deal with this. Frustrating, sure. I don't know, but how do we solve this thing? How do we be cool, man, and just figure this out and all get on the same page? And if the deal makes sense, how do we get this done as close to what we were anticipating as possible? Sounds like that's what happened.
Mhm.
Yeah, maybe get a little frustrated, but at the end of the day, it sounds like everybody's cool, man, and got back on task. And all right, let's adjust this thing. Let's revisit the value and make sense of what the transaction's actually going to be. And if the deal makes sense, let's get this done.
Yeah. So, parting words of wisdom from Dad Mode Brian.
That way.
If you could leave one last thing for the investors, you thinking about your borrowers that you work with, what would be kind of just your parting words of wisdom, Dad Brian?
We're kind of trying to talk a little bit specific, a little bit about numbers, a little bit about process. I think it can be a little paralyzing as an investor. I know there's a reasons why I don't really invest as much because it's hard to not take those risks. Like,
Mhm.
at the end of the day, real estate can be a risk and you never know what's going to end up happening.
Yeah.
As you said, you have to be a little bit flexible. Things change. Goes back to, hey, this industry is super new. Like
Mhm.
it's only been around for how it kind of looks today for
10
about 10
years.
years. Like things are going to continually change and
Mhm.
evolve. So I think there's know the deal, know what you're comfortable with. Don't overextend. Like find something where you can potentially put down a couple more thousand. Like if you're already at the upper echelon of like,
Mhm.
this is all the money I have to be able to put into this and
Yeah.
for reserves. Like maybe take a little bit some step back because again, deals change, like
Yeah.
ARVs
Real
change.
estate.
When you get that real professional third party opinion, it may look different than yours, and
Yeah.
which is a good thing. Like you want the person that's doing this day to day, either us like seeing hundreds of deals, or the
Yeah.
appraiser, or the
Yep.
lender. Like
Yeah.
they're looking at these deals a lot to see that. So it's just like make sure that you have some financial flexibility because again, deals change
Totally.
as we get the real numbers from
That's
everybody. So
that's
yeah,
very good.
try to find something.
Very good wisdom there, Brian. Thanks
Yeah,
so much again for
sure.
hopping on with us. And, again, if you are listening in, you can connect with Brian directly if you have a deal you want to work with, or just anyone from our LoanBidz team to help support you on your current or future investments. Thanks.
Thanks for listening to the Deal Vault. If you found value in today's episode, be sure to subscribe and share with another investor and leave us a review. If you're looking for help funding your next deal, you can always holler at us at loanbidz.com. We'd love to help you on that deal. Until next time, keep building, keep investing.